Right now, if you look at silver year to date, it's actually performed just a little bit better than gold. Well, basically the same, but a little bit better according to Bloomberg. Of course, it's come down, it ran up sharply at the second half of, in May and beginning of June. So it's come down from there. No, I think silver is very attractive right now, both as the physical and as the equities.
Precious metals continue to have a stellar year, with August continuing the bullish trend. While silver is outperforming gold year to date, the latter is at levels that would constitute a fresh all-time closing high. China's demand for silver is so strong that domestic prices of the precious metal are higher than international prices. Bloomberg reported that this would likely lead to more imports to the East Asian nation in the coming weeks. As the founder of Adrian Day Asset Management, Adrian Day believes silver is particularly appealing now. He highlights the significant differences between gold and silver, particularly in solar panels. He predicts continued growth in solar panel installations will drive silver demand, noting that their 10-year lifespan will further boost this need. Bloomberg reported on Wednesday that China's silver imports hit a 3-year high of 390 tons in December, and then hit 340 tons in April, well above the monthly 5-year average of 310 tons. While noting the differences on the supply side, Adrian explains that only 30% of silver now comes from primary silver mines. Most silver today is a byproduct of lead and zinc mining rather than gold. He stresses that silver supply is unresponsive to price changes, with miners unlikely to increase or decrease production based on silver prices alone. Global silver mine production is expected to rebound in 2024, with a 4.1% growth rate to 916.1 million ounces. The increase will predominantly be fueled by the resumption and ramp-up of operations temporarily halted in 2023. Despite these supply and demand differences, silver generally moves in tandem with gold in response to monetary factors. In this way, Adrian suggests that silver offers a best-of-both-worlds scenario. Now, we present the clips of Adrian Day's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I mean, as everybody focuses on the differences between gold and silver on the demand side, and they are very significant, particularly with solar panels, because solar panels, I think, are going to probably continue their growth pattern, and the silver that they require is a meaningful part of the total silver market. Remember also that at the moment, a lot of solar panels, they don't last forever. So you can install solar panels, and within 10 years, you will definitely have to replace them, and that's more silver. There's also differences, of course, on the supply side. And the difference is important on a long-term basis, and it's important for how it affects the market. Let's say 30 years ago, 25 years ago, the majority of silver production was from primary silver mines. It's 30% of worldwide silver demand comes from a primary silver mine, and a primary silver mine might be a gold-silver mine as 50-50, but most silver today is byproduct silver, and it's byproduct, not a gold, but it's of gold mine, but it's byproduct of lead or zinc. Now, this is really, really important, because what it means is that the silver supply does not respond very well to changes in the demand for silver and the price of silver. If silver goes to $30 tomorrow, your lead miner in Bolivia is not even going to think about expanding his lead production, because he's got 10% byproduct silver. The zinc miner in Peru is not going to produce more zinc just because the price of silver goes up. And that's true on the downside as well, of course. If silver collapses, you don't stop mining zinc just because your byproduct, because the byproducts tend to be relatively small, 10, 12%. And so the silver supply does not respond very well. And that's one of the reasons why silver can have these very, very exaggerated moves leverage moves, if you like, both on the upside and the downside, simply because the supply doesn't respond. And that's different from gold, of course. You know, if you look at silver today, but having said all of that, the differences in supply and demand, silver, broadly speaking, tends to move broadly with gold in response to monetary factors. So with silver, you're getting a little bit of a best of both worlds, if you like. I mean, right now, if you look at silver year to date, it's actually performed just a little bit better than gold, a little bit better, according to Bloomberg. Of course, it's come down, you know, it ran up sharply at the second half of, you know, in May and beginning of June. So it's come down from there. No, I think silver is very attractive right now, both as the physical and as the equities.
Adrian Day mentions that central banks in Uzbekistan, China, or Germany prefer physical gold over other assets, including uranium or mining stocks like Newmont or Barrick. According to him, these investors seek to protect their assets and turn to gold, a traditional store of value in China, rather than equities or cryptocurrencies. The World Gold Council's second quarter of 2024 gold demand trends report reveals that total global gold demand increased 4% year-on-year to 1,258 tons. Total demand was supported by healthy OTC transactions, up a notable 53% year-on-year at 329 tons. Moreover, Adrian underscores that Western investors have mostly been net sellers of gold this year, but see a recent shift with large OTC trades in London, likely by wealthy individuals or institutions. Despite this, retail investors haven't rushed into gold, signaling a gradual shift in sentiment. Let's get back to the interview.
I think what we've got to do is look at who's been buying gold and why have they been buying gold. And for the last 18 months and virtually all of this year, the number one buyer of gold has been central banks. Well, central banks are trying to diversify their assets away from the dollar and avoid the weaponization of the dollar. Gold is a traditional central bank asset. But the central bank of Uzbekistan or of China, for that matter, or Germany or anywhere else, you know, they're going to buy physical gold. They're not going to buy drums of uranium for their central bank reserves. They're not going to buy uranium, as perhaps a bad example, because uranium has done well. I mean, we can talk about that later. But they're going to buy gold and virtually to the exclusion of everything else. They're certainly not going to be buying Newmont or Barrick if they're trying to, you know, get away from the weaponization of the dollar. We have been beginning to see a little bit of movement from, and I'll break it down, from Western investors generally, because for Western investors, North America and Europe, have actually been net sellers of gold up until very, very recently, and net sellers on a consistent basis pretty much all year. What we've been seeing in the last 4-6 weeks, we've started to see some pretty large OTC trades in London. And you don't see those trades reported individually, but you see the aggregate. The suspicion is that there are a relative few very wealthy families, maybe institutions, but families and individuals who are wanting to get into gold. There is still no broad rush by what we'll call individual or retail investors to move into gold. And you can see that in coins. You know more about that than I do, but the coin dealers I talk to say, yes, there's been a little bit of a shift, but certainly no large wholesale rush into buying physical. And earlier in the year, some of my coin dealer friends were telling me they were getting more people who called were wanting to sell their gold than actually buy it. You look at the gold ETFs as well, GLD. For the last month, we've had a little bit more on the inflow, but still pretty balanced between inflows and outflows. And up until this month, up until August, It's been pretty much consistent selling, 3 or 4 days of selling for every 1 day of buying. That's beginning to shift, though, as I say, it's beginning to shift. So we're now seeing maybe 2 days of 3 days of buying for every 2 days of outflows from the GLD. So it's beginning to shift. The macroeconomic environment in the US and North America generally is not a positive. If you just took a snapshot, it's not really a positive environment for buying physical gold. Yes, the dollar's come down, but interest rates are still high. Inflation is apparently low and declining. The economy is still strong. In that sort of environment, gold is not the asset of choice. Now, I think that's shifting as more and more people see that, either they see more and more people are beginning to see that the economy is slowing, and the unemployment rate going up in the US 4 months in a row is one thing. And of course, the most important thing is Jerome Powell's speech on Friday at Jackson Hole, where he said the time has come to change policy, to shift policy. So the expectation is for an interest rate cut next month. And typically when the Fed first cuts interest rates, you see gold, gain traction. So I think over the next month, we're going to see more and more individuals and retail start moving into the gold space.
Despite fluctuations, the underlying trends suggest a promising future for silver, which will likely benefit from its industrial applications and historical correlation with gold. A long-standing projection has been that silver will eventually hit $50 per ounce. Although this milestone seems almost inevitable, the exact timing remains uncertain. How do you see the interplay between silver and gold affecting investment strategies in the coming years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.